Today is Friday, April 17th, 2026. And, we're looking at a situation where a narrow waterway, 6,600 miles away, just reopened.
Yeah, and it instantly triggered this absolutely violent stock market melt-up. I mean, the biggest we've seen over a decade.
Right. But then, if you look closely at the underlying data, the everyday American consumer has literally never felt poorer. So welcome to this deep dive.
Glad to be here.
Our mission today for you, the listener, is to basically cut through all that deafening noise of the financial and geopolitical headlines and synthesize what the reopening of the Strait of Hormuz actually means. Not just for the global architecture, but your portfolio and, your daily life.
Because it's a massive shift.
Exactly. And we are pulling from a huge stack of sources today. We've got intercepted Middle Eastern diplomatic cables, maritime shipping advisories, deep book financial market data, and even the Federal Reserve's internal labor models.
Okay, let's unpack this because the contradiction I just outlined is pretty glaring.
Yeah.
It is the defining macroeconomic puzzle of the year, really. I mean, we are watching multiple violently opposing realities just coexist right now.
Yeah, it's wild.
To understand how a single maritime choke point can, dictate the wealth effect for bankers in New York while simultaneously just devastating consumer sentiment for a family in Ohio, we have to start with the geopolitical earthquake that set this all in motion.
Right, the diplomacy side of things.
Exactly. And more importantly, the deeply fragile diplomatic architecture that's basically attempting to stabilize it all right now.
Well, let's dissect that diplomatic architecture because honestly, the narrative being sold on cable news is so drastically oversimplified.
Oh, completely.
For 7 weeks, the Strait of Hormuz, which is this crucial maritime artery that processes roughly 20% of the world's crude oil, plus a massive chunk of global liquefied natural gas, it's been functionally blockaded.
Shut down.
Right. And now we are looking at a supposed breakthrough. But it didn't just happen in a vacuum. It was sequenced.
Yeah, it was a very specific chain of events.
First, we saw that 10-day ceasefire agreed upon between Israel and Lebanon. And that specific pause appears to have acted as a sort of diplomatic master key.
That's a good way to put it.
It unlocked the framework for a 14-day truce between the United States and Iran. And the really critical variable in the background here, which people are missing, is Pakistan. They acted as the primary broker.
Yeah, and Pakistan's involvement is really the mechanical lever that made this whole thing happen.
How so?
Well, when you have a 7-week energy blockade, the pressure doesn't just hit Western markets, right? It structurally threatens the entire Asian continent's energy security.
Because they rely so heavily on that specific transit route.
Exactly. So Pakistan stepping in, it highlights this massive pivot in regional diplomacy. They are highly, highly incentivized to keep energy flowing just to avoid their own sovereign debt crises and literally to prevent their power grids from failing.
Wow, so it's survival for them.
Yes. They provided the back channel that was necessary for Iran's foreign minister, Abbas Araghchi, to actually step up to a podium and officially declare the Strait of Hormuz, quote, completely open for commercial traffic for the duration of the truce.
But I need to stop you right there.
Yeah.
Because if we look at the actual physical reality on the water, that diplomatic narrative just completely falls apart.
It really does.
I mean, Araghchi says completely open, right? And then former President Donald Trump immediately takes to Truth Social. He fires off these posts celebrating the reopening, declaring it, and this is a quote, completely open and ready for business in full passage.
In all caps, naturally.
Right, in all caps. But if you cross-reference those political statements with the operational details in our sources, the United States naval blockade on Iranian ports is still 100% active.
Very active.
And furthermore, the Iranian military is publicly warning that they will instantly reclose the strait if these highly specific yet super opaque conditions aren't met. So the physical chokehold hasn't actually vanished. So how open is this waterway in reality?
The short answer? It isn't.
Yeah.
What we are witnessing right now is the deployment of weaponized ambiguity. The old fog of war has basically transitioned into the fog of diplomacy.
Weaponized ambiguity. I like that.
Because you have these directly conflicting data points hitting the market at the exact same time, President Trump is broadcasting that Iran has agreed to permanently abandon strait closures and that they're going to suspend their nuclear program.
He even laid out a really detailed logistics plan.
Yeah, a highly specific plan where the U.S. and Iran will ostensibly collaborate to extract enriched uranium and actually transport it to the United States. And he's explicitly denying these rumors of a $20 billion cash for uranium exchange.
Right. But the flaw in that logic is that the other side of the negotiating table is actively disavowing it.
Completely.
Iranian officials are strictly denying any agreement regarding their nuclear program or uranium transfers. They are stating firmly on the record that transit through the strait is entirely conditional on the U.S., adhering to their own interpretation of the ceasefire terms. So the gap between these two narratives, it's large enough to sail an aircraft carrier through.
And that gap is exactly what we need to focus on today. For anyone, especially you listening, trying to navigate this landscape, it is absolutely imperative to detach entirely from the political grandstanding of both Washington and Tehran. We have to view these statements purely as data points.
Data points for who?
For algorithmic trading models. From a market mechanics perspective, it honestly doesn't matter which political narrative will ultimately prove true 3 months from now. The market trades on the delta between the worst-case scenario and the current perceived reality.
Oh, I see. So because the worst-case scenario was a permanent closure and, a cascading regional war, the mere perception of a pause, however factually murky it is enough to violently shift billions of dollars in capital.
Precisely. Financial markets are pricing in the probability of transit, not the guarantee of peace.
But that diplomatic ambiguity creates a massive physical problem out on the ocean.
It's a nightmare. Clicking a button to adjust a risk model in a New York trading terminal takes milliseconds. But navigating a fully loaded 300-meter oil tanker through a recently contested combat zone...
With an active U.S. naval blockade right there.
Exactly. That requires physical maritime certainty.
Which brings us to the logistical nightmare that is currently unfolding on the water. Because the physical reality of global shipping right now directly contradicts all that optimism we're seeing in the equity markets.
Yeah, the disconnect is huge.
The U.S. Navy just blasted an advisory to all commercial seafarers in the region, and it's written in all caps for a reason. Let me read this. It says, "Status of mine threat in parts of the Strait of Hormuz not fully understood, and avoidance of area should be considered."
Yeah, that's a chilling message for a captain.
Right. If the U.S. Navy is telling you the mine threat is not understood, that is essentially a death knell for maritime insurance underwriters.
And the insurance mechanism is the invisible hand controlling the strait right now. We have to understand that sea mines are not just explosive hazards. They are uninsurable risks.
Because you can't quantify the probability of hitting one.
Exactly. The Joint War Committee in London, they dictate the premium rates for maritime conflict zones. If the threat level is officially not fully understood, the premiums required to insure a $100 million vessel and its cargo skyrocket. They go to levels that completely wipe out any possible profit margin for the voyage.
It's not even about bravery, it's just math.
It's pure math. Furthermore, Iran is dictating what they call a coordinated route. They are basically forcing commercial traffic into a highly specific, shallow bathymetric path near Larak Island.
Right up against their coasts.
Right against the Iranian coastline.
It's an assertion of absolute tactical dominance. By forcing these massive commercial vessels into shallow designated corridors near a coastline during a tense ceasefire. I mean, Iran isn't offering freedom of navigation. They are offering heavily surveilled, heavily permitted transit under the direct firing line of their coastal artillery.
Which fundamentally changes the legal and operational status of the waterway. And the shipping data confirms the industry's absolute terror right now. In the last 24 hours, only 14 ships have made the transit through Hormuz.
14 ships. That represents just 23% of normal daily traffic.
Barely a trickle.
If the strait is, as they say, completely open for business, why is nearly 80% of the global fleet refusing to move?
Because maritime conglomerates operate on risk models, not political tweets. Major shipping associations and logistics giants, companies like Maersk, Hapag-Lloyd, and BIMCO, they are reacting with intense, calculated caution.
BIMCO specifically warned about this, right?
Yes, BIMCO has explicitly cautioned its members regarding the unclear mine threat. You do not send a multi-million-dollar asset and a civilian crew into a potentially rigged waterway until the physical risk is swept and verified.
It's like a major highway reopening after a massive pileup, but authorities are forcing all the 18-wheelers to drive on the dirt shoulder because the main lanes might still have active landmines.
That is a perfect analogy. You're moving, but you're definitely not safe.
And the international community's panic over this ambiguity is palpable. UK Prime Minister Keir Starmer just rushed to Paris to co-chair an emergency global summit of 50 countries, focused strictly on forcing maritime certainty in the strait.
It's a huge mobilization.
But the most revealing detail from that summit came from Ukrainian President Volodymyr Zelensky.
Yeah, this was fascinating.
He joined via video conference, and he offered to deploy Ukraine's direct military assistance to the Persian Gulf. He leveraged the fact that Ukraine possesses 4 years of brutal, real-world asymmetrical warfare experience in the Black Sea. I mean, escorting merchant vessels, demining complex coastal waters, and successfully defending against the exact same Iranian-designed drone architecture that currently threatens Hormuz.
And Zelensky's offer really highlights the profound integration of modern geopolitical theaters. The drone technology refined in the Black Sea is the exact same threat matrix that's terrorizing the Persian Gulf today.
It's all connected.
But, the underlying reason for this desperate 50-nation scramble to secure a narrow strip of water comes down to the staggering financial cost of the alternative. We have to look at the mechanical ripple effects of the past 7 weeks, specifically the arbitrage environment that completely paralyzed global supply chains.
The arbitrage data is really where the sheer desperation of the global energy market becomes visible. Because the strait was closed for 49 days, these massive shipping companies faced a catastrophic math problem.
Right.
Starved energy markets in Asia and Europe still required continuous baseload power. And liquefied natural gas, LNG, doesn't just sit nicely in a tank. It slowly boils off the longer a voyage takes.
You're literally losing product every day you're on the water.
Exactly. So ships were forced to abandon the Middle East entirely and source energy from alternative regions, requiring vastly longer routes that all happened to converge on a single geographic bottleneck, Panama Canal.
And the Panama Canal basically became the choke valve for global energy desperation. In the maritime industry, time is quite literally capital.
Yeah.
When you add 3 weeks to a voyage by routing all the way around South America, you aren't just burning more bunker fuel. You are incurring massive opportunity costs and brutal default penalties on your delivery contracts.
And that desperation materialized in auction premiums. Shipping companies were paying up to $4 million in transit auction fees at the Panama Canal. And I want to be super clear on what that means for you listening. That $4 million does not pay for the gas, it does not pay the crew, and it does not pay for the ship.
No, not at all.
It is purely a bribe to the Canal Authority to skip the line.
It is the physical manifestation of a geopolitical tax. If an energy conglomerate has a cargo of LNG that an Asian utility desperately needs just to prevent rolling grid blackouts, paying a $4 million premium to jump the queue is mathematically rational compared to the penalties of late delivery.
Wow. You put it like that.
But that $4 million premium doesn't just vanish into thin air. It cascades right down the supply chain. It is instantly baked into the cost of industrial manufacturing, the cost of aviation fuel, and ultimately the cost of the consumer goods you buy.
Which perfectly explains the violence of the financial reaction we saw today in the markets. The moment the market algorithms processed even a viable path to that logistical bottleneck easing, the bottom absolutely fell out of the energy market.
It's just collapsed.
Let's look at the plumbing of this collapse. Oil prices plunged over 10% in a single session. Brent crude, which is the global benchmark, fell below $90 a barrel. West Texas Intermediate dropped near $83. And we saw parallel double-digit percentage collapses in heating oil and gasoline futures.
If we connect this to the bigger picture, to understand the mechanics of that sudden drop, we have to define the conflict premium.
Okay, break that down.
For the preceding 7 weeks, the futures market was operating in a state of severe geopolitical backwardation, meaning the price of every single barrel of oil had a massive fear tax embedded right into it. Institutional models were forced to price in tail risks.
Like the war spreading.
Exactly. The probability of the conflict expanding, the risk of Saudi or Emirati refinery infrastructure being actively targeted, or the threat of a multi-year strait closure.
So buying energy futures during that blockade was basically like trying to purchase flood insurance while the hurricane is already hovering over your house. The premiums are astronomical because the damage is perceived as imminent.
Exactly. And when that storm suddenly downgrades and moves offshore, which is exactly how those algorithmic models interpreted the ceasefire announcement that structural insurance premium evaporates in seconds,
Just gone.
gone. From a macroeconomic perspective, a 10% overnight drop in global energy prices functions as an instantaneous, massive global tax cut.
Oh, that makes sense.
Think about the mechanical impact on a corporate balance sheet. Suddenly, the forward-looking input costs for global airlines, industrial manufacturers, and international logistics firms just plummet. That projected capital is instantly freed up, and it flows immediately into equity valuations.
Which triggers what financial analysts are already dubbing the Pax Hormuz rally. Though, I mean, if you look at the trading volume, it looks much more like a lockout rally.
Nice. Lockout rally is the accurate term here.
The velocity of this stock market melt-up is staggering. We are looking at an S&P 500 that just crossed 7,100. That is a 12% surge from its March 30th bottom.
The mechanics of the lockout rally are crucial to understand here. For 7 weeks, institutional asset managers and hedge funds de-risked. They moved massive allocations out of equities and into cash equivalents, terrified of a regional war triggering an energy super spike that would crush the economy.
Right, they were playing it safe.
But when the ceasefire broke, those managers found themselves fundamentally underallocated to equities in a rapidly rising market.
And because institutional managers are graded against benchmark indices, sitting in cash while the market rips higher is literally a career-ending risk.
You will lose your job.
They are locked out, and they are forced to aggressively chase prices higher just to catch up to the benchmark. And you can see the panic buying clearly in the Nasdaq 100. It is up 5.9% for the week, hitting a 13-day winning streak.
Which is historic.
We have not seen a 13-day consecutive winning streak on the Nasdaq since 2009. Coming out of the great financial crisis. And the VIX, the volatility index that tracks market fear, it was crushed today, dropping 41% from its peak.
It is a violent structural recalibration of risk. It really demonstrates the sheer volume of liquidity that is currently trapped within the global financial system, desperately searching for yield. When the systemic tail risk of a global energy crisis is momentarily removed, that capital deploys with terrifying speed.
But this stock market euphoria creates a massive logical problem. If the entire premise of this rally is based on cheap energy and the relief of global physical supply chains, why is the real engine of this 13-day Nasdaq win streak a sector that supposedly operates independent of physical logistics?
You mean tech?
Yeah, we were talking about big tech and the AI supercycle. It's almost as if the tech sector operates in a completely separate gravitational field from the rest of the world.
Because the technology sector currently believes its growth trajectory is immune to traditional macroeconomic physics, the market is pricing AI infrastructure not as just another software iteration, but as a mandatory evolutionary step for human commerce.
And the capital flows completely validate that thesis. Trillion-dollar behemoths, Microsoft, NVIDIA, Amazon, Alphabet, they are structurally soaring. Microsoft just posted its best week since 2015. But the most shocking data point of the week, hands down, belongs to Oracle.
Oracle was unbelievable.
Oracle gained 32% this week. 32% for a legacy tech giant. That is its best weekly performance since the height of the dot-com bubble in 1999. And if you look at the catalyst, it wasn't a cool new software rollout. It was an announcement of a 1.2 gigawatt AI data center deal with Bloom Energy.
We really have to pause and translate what 1.2 gigawatts actually represents in physical reality.
Yeah, give us a sense of scale.
A standard large-scale enterprise data center might consume somewhere between 30 to 50 megawatts of power. 1.2 gigawatts is the output equivalent of a medium-sized nuclear reactor.
A nuclear reactor. For one deal.
Yes. Oracle is no longer just selling database subscriptions. They are structurally transitioning into industrial power utilities.
But why does an AI system require the power grid of a small city? Walk me through the actual mechanics of that energy draw.
It comes down to the thermal physics of advanced GPU clusters. Training a massive large language model requires tens of thousands of highly specialized chips operating at maximum capacity continuously for months.
Just crunching numbers nonstop.
Exactly. And these chips draw immense electrical current, which immediately converts to heat. You are not just paying for the electricity to run the calculation. You are paying for the massive, continuous industrial liquid cooling infrastructure required to prevent the silicon from literally melting.
So power is everything.
Power is the ultimate bottleneck. The market is currently rewarding any technology company that can prove it has legally and physically secured the baseload electrical grid capacity to build these compute environments.
It's basically an infrastructure land grab at this point. And this hyper-competitive dynamic is entirely global. Take Apple, for example. They just reported a highly unexpected 20% surge in iPhone shipments in China for the first quarter.
Which caught a lot of analysts off guard.
Totally. Against the backdrop of intense U.S.-China trade friction, Apple has managed to close the gap, coming within 1% of matching Huawei's domestic market share in the region.
Which completely dismantles the prevailing narrative that Chinese consumers are systematically boycotting Western hardware ecosystems.
Right. But the most aggressive front of this global tech war is in the silicon itself. The absolute dominance of NVIDIA is suddenly facing legitimate multi-vector attacks from all sides.
The AI chip wars are escalating incredibly fast.
Yeah, we are tracking a European startup called Euclid, which is backed by the former CEO of ASML, and ASML is the company that builds the massive machines that print the chips. Euclid is claiming they have engineered a chip design that offers 100 times the power efficiency of NVIDIA's current flagship hardware.
And if data center power is the ultimate bottleneck, as we just discussed, a 100x efficiency gain completely rewrites the unit economics of AI. It changes the whole game.
And simultaneously, on the other side of the globe, a Chinese startup named DeepSeek is actively seeking a $10 billion valuation, and they're doing this while operating under massive targeted U.S. chip sanctions. So how are they training world-class AI models if they are legally barred from buying the necessary hardware from companies like NVIDIA?
They are bypassing the hardware sanctions through sheer software optimization.
How's it work?
Well, the U.S. export controls were designed to block the transfer of high-bandwidth, highly interconnected GPUs. The theory in Washington was that without fast, physical interconnects between the chips, you simply couldn't train a massive model.
It would just take too long.
Right. DeepSeek responded by heavily optimizing their software architecture, using techniques like sparse mixture of experts, which mathematically reduces the need for the chips to constantly communicate with each other.
Wow, so they just coded around the physical limitation.
Exactly. It proves a fundamental law of technology. Engineering innovation will always route around geopolitical blockades.
Okay, but if the market is blindly throwing billions of dollars at literally any company remotely attached to tech and AI, how do we explain the bloodbath in Netflix stock?
Yes.
Because the broader market is historically hot, tech is soaring, yet Netflix completely tanked on Friday, closing down 10%. And the mathematical paradox here is staggering to me. Netflix fell 10% after receiving a massive $2.8 billion breakup fee because they walked away from the Paramount, Skydance, and Warner Bros. Deal.
Right. They literally received nearly $3 billion in free, unencumbered cash, and Wall Street punished them for it. Why?
The Netflix collapse is a masterclass in the mechanics of valuation multiples and the lethal danger of being priced to perfection. When a market enters a state of absolute euphoria, sky-high expectations cease to be an asset and they become a structural liability.
Break down the math on that for us. What actually constitutes being priced to perfection in, say, a discounted cash flow model?
Let's look at the core data. Netflix beat their first quarter earnings estimates. They absorbed that $2.8 billion termination fee, which undeniably bolsters the balance sheet.
It's pure cash.
Pure cash. However, going into earnings, the stock was trading at a 583% premium relative to analysts' baseline estimates of its fair value.
583%.
Yes. A multiple that high means investors are not paying for the cash flow the company generated yesterday. They are mathematically pricing in years of flawless compounding future growth.
And Netflix failed to project that flawless future. Exactly. They issued weak forward guidance for the second quarter, specifically signaling that their new ad-tier revenue growth wasn't accelerating at the velocity that the most bullish algorithmic models demanded.
It was growing, just not fast enough.
Right. Furthermore, they announced a massive shift in corporate governance. Co-founder Reed Hastings is officially stepping down from the board.
So you combine a slight deceleration in projected growth with the sudden departure of the visionary architect of the entire company.
And when a company's valuation multiple is stretched to 583%, there is zero margin of safety. None. Any slight hesitation in guidance, Any shadow of doubt regarding leadership triggers algorithmic trading models to mercilessly compress that valuation multiple in milliseconds.
So the takeaway for you, the listener, observing this tech supercycle is vital. In a roaring bull market, beating yesterday's earnings is basically irrelevant. You have to beat the unstated whisper number, raise future guidance exponentially, and project absolute invincibility. The moment you blink, the capital rotates out.
That is brutal, but the mechanics make total sense. Expectations as a liability.
Now, while software multiples are compressing over ad-tier guidance, the physical realization of supply chain vulnerability, which the world literally just learned the hard way during the 49-day Hormuz closure, has triggered a literal gold rush in a totally different sector.
Yes, the critical materials sector. This is the physical terrestrial anchor to the digital cloud-based streams we were just discussing.
You can't have one without the other.
You really can't. You cannot manufacture a 1.2 gigawatt AI data center. You cannot build electric vehicle fleets. And you certainly cannot deploy advanced military defense systems without a deeply secure supply of rare earth elements.
Here's where it gets really interesting. This brings us to the explosive 35% surge today in a mining company called Critical Metals Corp, trading under the ticker symbol CRML. A 35% jump in a single trading session is massive. But the catalyst behind this move is the perfect case study in the systemic panic over global supply chains.
It really is.
CRML just secured 92.5% ownership of the Tanbreeze project.
And the geographic location of Tanbreeze is what makes this a massive geopolitical event, not just a standard mining play. It is located in Greenland.
Greenland.
Yes, Greenland. Tanbreeze happens to be one of the world's largest undeveloped deposits of heavy rare earth elements. And the critical indicator of how seriously the geopolitical establishment is taking this is the financing.
Right, follow the money.
CRML is heavily backed by a $120 million letter of intent from the U.S. Ex-Im Bank, the Export-Import Bank of the United States.
The U.S. government is literally stepping in to de-risk the capital stack for a mine in Greenland. But I want to make sure we don't fall into the trap of oversimplifying this. People often use the analogy of, a town with only one grocery store to explain China's monopoly on rare earths.
Right, I've heard that one.
But that implies anyone can just open a new store if they find the right real estate.
Yeah.
The reality of rare earth supply chains is much closer to crude oil and specialized refineries, isn't it?
That is the exact mechanical distinction that matters here. Rare earth elements are actually quite abundant in the Earth's crust. Finding the crude, the raw dirt in Greenland is really only step one.
So what's the bottleneck?
The bottleneck, and the reason China maintains a near-total monopoly on the industry, is the metallurgical refining process. Elements like dysprosium and terbium are chemically bonded together in the ore. Separating them requires highly complex, incredibly toxic solvent extraction processes.
So China's monopoly isn't just geographic. It's based on decades of accumulated metallurgical expertise and, frankly, a willingness to absorb the massive environmental degradation required to refine these metals.
Precisely. So when a company like CRML secures a massive deposit in Greenland, along with the U.S. government backing required to potentially build out Western processing infrastructure, the market reprices the asset instantly.
Because it's a strategic necessity.
Dysprosium and terbium are the fundamental building blocks for the permanent magnets required in F-35 fighter jet engines and Tesla drivetrains. You literally cannot sustain a modern military or transition to green energy without them.
So, a blockade in the Middle East violently exposes the vulnerability of maritime choke points, which immediately sends a jolt of urgency through Western capital markets, which accelerates government-backed mining investments in the Arctic. The entire global system is mechanically linked.
It is entirely interconnected.
But this brings us to the most jarring structural disconnect in all the research we pulled today. Because while Wall Street is actively popping champagne over secured Greenland supply chains, AI data center buildouts, and easing oil futures, Main Street is experiencing a completely different, mathematically contradictory reality.
And this is where we must pivot to the macroeconomic data, specifically the internal labor models of the Federal Reserve and the psychology of the everyday consumer, because the structural foundations of how the U.S. economy actually measures health have fundamentally broken down.
We have a speech delivered today by Federal Reserve Governor Christopher Waller, explicitly titled, "One Transitory Shock After Another." In it, he outlines a framework that quantitative analysts are dubbing the no hire, no fire doctrine. You need to walk us through the mechanics of this labor paradox because it completely contradicts decades of established economic theory regarding employment and recessions.
It turns it upside down. To understand the no hire, no fire doctrine, we have to look at the demographic denominator. Historically, the Phillips curve and traditional economic models dictated that a growing U.S. economy needed to generate roughly 200,000 new non-farm payrolls every single month just to keep pace with natural population growth.
Right, the baseline target.
If job creation fell below that or printed negative, it mechanically signaled a recession. But Governor Waller pointed out a profound demographic inversion that finalized this year in 2026.
The immigration and aging metrics.
Exactly. Net immigration into the United States has mathematically fallen to near zero this year. Simultaneously, the peak of the baby boomer generation is structurally aging out of the workforce. They're retiring in massive ways.
So when you combine those two demographic forces, the replacement rate of the labor pool is functionally stagnant.
Meaning the denominator has shrunk. There are physically fewer new human beings entering the labor force looking for jobs.
Therefore, according to the Fed's revised models, the U.S. economy currently requires almost zero net job creation to absorb new workers.
Which is a fundamental paradigm shift. A monthly jobs report of zero, which would have triggered widespread market panic and recession fears 5 years ago, now represents an economy running at absolute full demographic capacity.
But what about the employer side of the equation? If the economy slows down, why aren't corporations initiating mass layoffs to protect their margins? That's what they usually do.
Because corporate executives are operating with massive institutional PTSD from the post-pandemic labor shortages.
Oh, the Great Resignation era.
They vividly remember the operational paralysis of being unable to staff their facilities and the exorbitant cost of recruiting and training replacement labor. So modern corporate balance sheets are actively hoarding labor.
Labor hoarding.
Even if forward-looking revenues soften slightly, companies are absorbing the margin compression and refusing to fire workers. They are terrified they won't be able to rehire them when the business cycle inevitably turns back up.
So the traditional gauges on the economic dashboard are entirely miscalibrated. We could theoretically see consecutive months of flat or even slightly negative payroll growth without it signaling a broad economic contraction. That is wild.
It rewrites the textbooks.
So if the labor market is structurally secure and the stock market is compounding 13-day win streaks, the average consumer must be ecstatic, right?
What's fascinating here is that this is where the macroeconomic paradox hits its absolute apex.
Because today, the University of Michigan released its April Consumer Sentiment Index. And it didn't just dip, it spectacularly crashed. The index fell a massive 11%, plunging to an all-time record low of 47.6.
The emergence of this data points to a phenomenon we can categorize as the inflationary anxiety gap. The traditional economic concept of the wealth effect, the theory that when stock portfolios and home equities rise, consumers feel psychologically wealthier and increase their velocity of spending it, has entirely decoupled from reality for the bottom 80% of the socioeconomic strata.
Walk me through the psychology of that decouple. If gas prices just dropped 10% today because of the Hormuz news, why is the Consumer Sentiment Index at a record low?
Because you have to separate the rate of change from the absolute level. Wall Street algorithms trade on the rate of change. When crude oil drops from $95 to $85, the rate of change is negative, inflation pressure eases, and the stock market rallies.
Okay, that makes sense for the traders.
But the everyday consumer does not live in a world of derivatives and derivatives of rates. They live in a world of absolute price levels.
So while Wall Street cheers that the inflation rate dropped from 4% to 3%, the consumer is looking at the compounded math.
Exactly. The University of Michigan data reveals that consumer inflation expectations for the year ahead have actually spiked to 4.8%. Consumers are feeling the intense compounding friction of prices that have structurally reset higher over the last 4 years.
So the damage is already done.
Yes. The cost of a basket of groceries, the cost of financing a used vehicle at 7% interest, the cost of property insurance, these absolute levels have not reverted.
Wall Street looks at the terminal and says, great, the geopolitical crisis is paused, oil is down, by the Nasdaq. Mean Street looks at the gas station sign and says, it doesn't matter if it's down 10 cents today, it's still $3.50 a gallon, and a carton of eggs still costs double what it did in 2019. The crisis is permanent.
A historic rally in the S&P 500 does not mathematically or psychologically offset the devastation of compounded inflation at the grocery store for the vast majority of the population. We are flying the economy on two completely different sets of instruments.
So what does this all mean? Let's pull all of these massive conflicting forces together. We are looking at the dawn of what the market desperately hopes is a Pax Hormuz. A critical waterway 6,600 miles away opens under incredibly fragile, weaponized, and conditional terms.
Very fragile.
In response to the perceived easing of a $4 million logistical bottleneck, energy futures collapse. That triggers a violent lockout rally, sending tech stocks and AI infrastructure plays to historic record-breaking multiples, completely ignoring the fact that shipping conglomerates are still terrified to actually sail the strait.
Because of the mines.
Right. Meanwhile, the Federal Reserve essentially rewrites the mathematical rules of employment, and the American consumer completely rejects the entire narrative of economic prosperity. It really highlights the danger of relying on a single data stream. You can't just look at a stock chart or a political social media post. You have to mechanically connect the tanker captain in the Persian Gulf, the AI power grid developer in Texas, the rare earth metallurgist in Greenland, and the consumer in the grocery aisle.
Because every single one of them is reacting to a different mechanical facet of the exact same global shock.
Before we wrap up this deep dive, we always want to leave you, the listener, with a final lingering thought, a framework to apply to the next wave of headlines. Because over the last hour, we just mapped how the physical closure of a single watery choke point for 49 days forced a violent restructuring of global capital, arbitrarily redirected thousands of maritime vessels, and shattered consumer psychology.
And this raises a critical systemic question for you to explore on your own. If the physical closure of the Strait of Hormuz could induce this level of global panic and financial arbitrage, what happens when the next major geopolitical choke point isn't a physical waterway at all?
What do you mean? Like not a canal or a strait?
Exactly. What happens when the strait that gets blockaded is a digital one?
Oh.
Imagine a state-sponsored, targeted shutdown of a major undersea fiber optic pathway, or the blinding of a critical global satellite network via low Earth orbit debris. We saw the intense desperation over physical supply chains today, with companies paying $4 million just to move a physical ship through Panama.
Yeah, just to skip the line.
But in an era where everything from global banking liquidity to AI data center operations depends on absolute, uninterrupted data flow, the panic over a severed digital supply chain would make the Hormuz closure look like a minor traffic delay.
If the Nasdaq requires 1.2 gigawatts of power just to train the models that run the modern economy, a digital blockade wouldn't just delay shipments, it would instantly freeze the core valuation of the entire tech sector.
Overnight.
Our portfolios and our societal infrastructure mechanically prepared for a digital Strait of Hormuz. That is a terrifying but entirely necessary question to ask as we watch these tech multiples just climb to the moon.
Something to think about.
Definitely. Thank you so much for joining us on this deep dive. Keep questioning those headlines. Keep demanding to know the mechanics beneath the surface. We will catch you next time.